Hey, everybody. Hopefully you are finding the day to be productive and informative. I'm going to come now just to talk about two of our new growth initiatives. And I'm going to reference back to my earlier comments about our roadmap. You heard firsthand from Frank what he's experiencing a mere 2 months into his integration into the platform in terms of the revenue synergies, the fundraising momentum, and the collaboration. We're a little bit farther along on our SSG activities and our insurance build, so I thought it would be helpful to maybe give folks an update on those two businesses, where we see them going, and how we're applying that consistent strategic roadmap to the business build. So, SSG. If you think back to the roadmap, it's simple. Large addressable market, high quality team with a deep track record and a unique set of capabilities, and a significant amount of growth opportunity in region to expand flagship product and to expand into adjacencies. So we could not be happier. We're well over a year into the integration of the SSG platform. As it sits here today, $7.5 billion of AUM, market leadership position in the Asia-Pacific private credit markets in two flagship products today, special situations, AKA distressed, and senior secured lending. So let's just talk about the market. What did we see? Why were we so excited? And why did we choose to acquire versus build? Oftentimes, as Frank articulated, when we are going into a market through an acquisition, it's because we see transformational growth on the horizon, and we have a sense of urgency to get leadership position and capability quicker than we otherwise could if we were building organically. And SSG is a great example of that. If you look at projections for global GDP growth over the next 10 years, 2/3 of the global GDP growth is coming in the Asia-Pacific region. We need to be there, but we need to be there with real deep capabilities and local knowledge. If you also look at the growth in non-bank lending in Asia, you're going to see a rapid acceleration of the growth in that market, just given some structural changes that are happening throughout the region as well. Now, I talked earlier about pattern recognition as we build businesses. We saw this in Europe. We went into the European private credit market when no one else was there, 2006 and 2007. We had a view that we were seeing a lot of the same trends emerge in that market in terms of the growth of the middle market economy, the restructuring of the banking landscape, changing regulatory capital frameworks, growth in the private equity market, driving more consistent demand into the private credit markets. And we were right. Now we've grown that to be a market leader. We're seeing similar trends begin to emerge in the Asia markets, but the market is still in its infancy. So to put that in perspective, if you look at the US direct lending market today, we think it's about a $1.5 trillion market that has largely debanked in the middle market. 80% of loans to middle market companies today are getting made in the private markets. Europe is on an accelerated trend following the US, roughly 70%. The market there is smaller. It's one of the reasons why we're so excited about our growth opportunity in Europe. If you look at Asia today, across the region, we can identify an addressable market today of $300 billion in direct lending with meaningful growth. But if you look at bank share of that market, we think it's still in excess of 75%. So this idea that we're going to follow the trend and the pattern that we've seen developing as we move east from the US to Europe through to Asia is something that we're keenly focused on. In order to capitalize on that, given all of the complexity in the region, different regulatory frameworks, different jurisdictional legal frameworks, all of the licenses, all of the cultural differences, we landed on what we believe is the premier private credit manager in Asia through SSG. We have a partnership there of senior leaders who have been investing together for well over 15 years, deep track record of extraordinary performance through cycles, invested across the region, 35 professionals and growing. And so this has positioned us to not only scale our private credit business, but continue to now expand our private credit franchise into ancillary markets and products. We always talk today and always about the assets and the performance, this is no exception. If you look at what we've been able to do in our core flagship fund families, we are now actively investing our 5th special situations fund. That family of funds since 2009 has generated gross IRRs of 34% and net IRRs of 22%. We've used that success to start to move into less risky, higher maybe quality risk-adjusted return in some cases, senior lending product, more consistent with what we're doing in the rest of the globe. And even there, we're generating 23% gross and 13% net. And we recently had a very successful close on our 3rd fund in that family at $1.3 billion. It was almost 2 times the size of the predecessor fund and in excess of the cover that we set out to target. Similar to what Kip talked about, they've been able to generate these types of returns with low loss rate. Any credit investor worth their salt has to be able to deliver differentiated returns with low losses. Our Asia business is no exception, and if you look since inception 2009, coming out of the GFC, we've had annualized loss rates in this business of about 20 basis points. So obviously, with that type of performance, we've seen meaningful growth. This platform has scaled close to 40% compound annually over the last 5 years, and we expect that growth to continue along this strategic path. Invest well, grow our core flagship funds, expand the product offering, which we are already doing actively, and you should expect to see new funds coming out, things like unitranche funds and sponsored lending funds in the more developed parts of the region. And then take the embedded local knowledge that we have, the experience we have in places like real assets and secondaries, and scale them into the region as well. So this is the first time that we've actually been speaking to folks about where we see the opportunity through the SSG platform. But if we execute just on what we see in front of us today, we think that we can take this platform from $7.5 billion today to close to $20 billion in 2025, and hopefully beyond as we expand into other adjacencies. So that's a 20 to 25% CAGR, again, consistent with the firm-wide expectations. Let's talk about insurance. You heard Ryan and others talk about the opportunity to sell assets into the insurance market. It's one of our fastest growing third-party client segments. And the reason for that is obviously, like most institutional investors, insurance companies are struggling to find differentiated yield in a low interest rate environment and are frustrated by traditional fixed income assets. So not surprisingly, they're deepening their partnership with alternative asset managers like us in order to get better risk-adjusted return, excess yield, but also more access. Better allocations, more access to help really drive a shift in their portfolio composition. So what we are trying to build here, and I'm really, really excited about the early success, is to aggregate capital and capabilities in the insurance space under our Aspida umbrella to go after the growth in the insurance market. And we plan to do that through 2 core pillars of our strategy. One is through building a captive reinsurance platform, Aspida Re. And the second is to build a captive, proprietary, and we believe differentiated annuity distribution and origination platform under the Aspida Life brand. And we're now well on our way to having acquired all of the people and capability set that we need to drive growth into this market. As Aspida sits today, we manage close to $3 billion of assets. Ares sub-advises about 30% of that book. Over time, as we add new capabilities across the alternative credit and real estate landscape, we would expect to see that 30% move to somewhere closer to 50 or 60% in terms of our ability to sub-advise our captive insurance assets. So let's talk about these 2 platforms quickly, annuities and reinsurance. We recently completed the acquisition of a platform called Global Bankers. Many of you know this has been in the works for quite some time. We are super excited about the capability set that has come here. We now have a team in excess of 100 people dedicated solely to the construction and distribution of fixed index and fixed annuity product. One other way to think about that part of the market is this is retail access to alternative investments. So as we grow the annuity book and as we increase the distribution, this is just one more way for retail investors to get the benefit that comes with an alternative asset. Unlike some of our peers, this is effectively a de novo build. We're not coming to this with any legacy infrastructure weighing us down. We don't have a back book. This is a very modern, tech-enabled distribution capability that we think that we can scale very dramatically. Many of you have asked us what we think this platform is capable of. We don't know yet because we haven't put our brand and pushed our relationships into the bank and wire channel. We haven't demonstrated what we can do from a product construction standpoint, given our unique asset capabilities. But if you just look at this platform under prior ownership, they were originating close to $2 billion per year of new liabilities. So clearly, we think that we can do better. Sitting next to our Life Co is our reinsurance platform. We launched that in earnest at the end of 2020 with the acquisition of F&G Re. That came with the $2.7 billion of assets. Importantly, we are already seeing meaningful growth in that platform through reinsurance flow agreements that are already in place with existing partners. As we sit today, just based on what is on the platform, we're generating $1 billion in annualized liabilities through our reinsurance platform. So adding those two, based on where we are today, roughly $3 billion of growth. Needless to say, with the capital base that sits behind Aspida and the momentum we have, we continue to be active in the M&A market. The pipeline for reinsurance transactions is actually quite significant right now. And so we would expect to continue to see growth in that market through flow agreements, but also increased M&A. So again, what are we hoping to accomplish here? Our approach to insurance is balance sheet light, but we recognize the opportunity to scale this meaningfully in partnership with third-party capital. We're going to do it, as I mentioned, in three ways: continue to drive direct origination through the GBIG platform, continue to drive growth in our reinsurance platform through M&A and increased flow agreements, and then look up and see if there are other assets that we could acquire that would be accretive to our capability and our scale there. So just based on that alone, again, what do we think success would be moderately? Would be to take this platform from roughly $3 billion today to $25 billion by 2025, or roughly a 50% compound annual growth rate. We're just getting started here, but really looking forward to demonstrating this type of momentum as we continue to grow this platform.